Good morning, everyone. Welcome. With so many invitations and events competing for space in our calendars these days, we genuinely appreciate you taking the time to join us. And given today's topic, it really tells me one of three things. You are deeply committed to your business. You are seriously concerned about regulation and changes reshaping our industry, or you are strategically avoiding something else in your inbox. Either way, welcome. Before I even start, I thought I'd frame today with a few global perspective points, because what we do in this industry is very unique. As collective financial advisors, we manage trillions globally. We influence life decisions across generations, and yet we still get asked over a braai, what do we do? Globally, there are roughly 350,000 financial advisors. In the United States, over $30 trillion sits in advised retail wealth. And yet, in most developed markets, fewer than 30% of households actually work with a financial advisor. So the advice gap is real. Close to home, South Africa, we have roughly 16,000 practicing advisors across both non-tied and tied models. Independent advisors alone oversee more than 2 trillion in retail savings and investment assets, with the average advisor age early to mid-50s, and a growing proportion are considering succession, say, like next few years.
Miss Act.
Evan will unpack the detail, but those statistics tell you something important. The industry is not just evolving, it is consolidating. Across major markets like the UK and Australia, when regulatory intensity rises, advisor numbers fall, consolidation increases, costs to serve rise, and clients with smaller balances get left behind. In Australia, advisor numbers fell by nearly 30% following the Royal Commission. In the UK, consolidation multiples spiked, and regulators eventually stepped back in. South Africa, no mistake, is not immune to these structural pressures. And then there's technology. More than 50% of advisors globally are now using AI tools in some way, shape, or form, mostly for communication and admin efficiency. But fewer than 20% say it is actually meaningfully improving their profitability. So the question is not, are we using AI? Most people are. The question is it changing the economics of advice? I think the tension between innovation, cost, regulation, and consolidation is exactly why conversations with Evan like here today matter. The advice industry is also fascinating because there are some very strong beliefs. Asset managers believe they drive the economics. Platforms believe they drive the ecosystem. DFMs believe they protect the advisor. Regulators believe they protect the clients. And advisors believe they are holding it all together. They are probably the most. We are fortunate today to have someone who spends an extraordinary amount of time analyzing this industry, not only from anecdotal product bias, but through structured engagement with advisors, platforms, and asset managers across markets. Evan brings direct advisor interviews, platform benchmarking, flow and trend analysis, and international comparative insights. It's data-driven, it's candid, and it addresses structural realities. So today we're going to unpack what advisors are really thinking, where platform competition is really tightening, where economics are shifting across the value chain, and what this likely means over the next 3 to 5 years. So let's move from speculation to evidence. There is a Q&A section right next to the chat button, so please feel free to submit any questions. We will address them at the end. With that, Evan, I'm going to hand over to you. Thank you.
Great. Thank you, Darren. And looking forward to the session. I'm just going to share screen and hopefully everyone will be able to see it shortly. Great. So I'm hoping that's now visible. And I'm not sure if there's a way for someone to confirm that to me, but otherwise, okay.
We can see it.
Great. Thank you. So I'll jump straight in, and I think, Darren, there's a lot of points you raised there that we'll be able to kind of build on and talk through and link in quite nicely to what we're going to look at here. I'll do a little bit of kind of positioning up front, talk about very briefly where I fit in, where NMG Consulting fits in, but kind of then more importantly, as Darren said, we're evidence-based here. We're going to be using work that we've done to talk through some of these topics. So I'll give a bit of context around what that work is and what the source of the graphs and the analysis is. But I think fundamentally the goal for us, or the topic that I'm looking at today, is as part of a retail wealth market update, the real kind of key line, if you will, for me is focus in a distracted market. Because what we're finding is that increasingly, well, we would challenge advisors to think about things as what is core and what is the distraction. And there's a lot of distractions, but for those who really figure out what's core and work on that, there's a big opportunity. So quickly, just to position. So NMG, we're a global consulting firm. I'm not going to kind of read out all the bits on the slide, but rather just to say that we work across the value chain. We work across insurance to investments. We do a lot of our work is with advisors, and we like to think of ourselves as kind of specialized in that area. So trying to understand the advisor's point of view, but also engagements with clients and engagements with the rest of the value chain. And then we engage also, of course, with DFMs, asset managers, platforms, insurers, etc. as part of that work. We are global, but I think what's interesting about us is that we are founded by South Africans. So we're a bit of a weird global consultancy because South Africa is a tier one market for us, alongside markets such as London. I'll come back to the UK, North America, Asia, Australia. And these are really interesting, I think, because a lot of the developments we see playing out in these other markets become relevant for South Africa. And in some areas, South African developments are relevant for the rest of the markets as well. So I'm Evan Baars. I'm the partner that runs our UK and South African consulting business. And so I'm constantly between the two. Right now, I'm fortunate enough to be in South Africa, in Cape Town today, but always across the two. And that's why we'll kind of compare notes in those markets. As I said, today's session, we're looking at really kind of focus in a distracted market. I don't need to kind of, talk too much about this quote, let the main thing stay the main thing. But I thought this was a really interesting one just because in all these advisor interviews, and I'll get to those advisor interviews in a second, but in all discussions with advisors, sometimes it feels like advisors have really figured out this is where I add value and this is the main thing. And in other cases, we hear advisors going down what we think are potentially rabbit holes and spending a lot of time on things that we think are maybe detracting, if anything, from the main thing and from what the clients perceive as the kind of main value add. So it's over a decade of interviews that we run every year, even just specifically within South Africa. But the way we're kind of positioning the thinking today is, firstly, what's the context we're operating within? Because if you don't know your context, then you're really on the back foot to start. A lot of this is probably just recap. You'll be very familiar with that, of course. The second is then, how are we growing revenue and protecting margins, and kind of focusing there on the revenue line of a business. We also do then want to kind of categorize a little bit what we perceive as where the real value is. So what's core, and then what's the distraction? And then finally, what does efficiency look like? And so this is roughly the kind of structure that we're going to be thinking about things in terms of, but also from a P&L perspective, we'll think first kind of growth in revenue, then costs, and then tie that all together. The study that we're leveraging is one particular one that we run every year in South Africa. And a lot of you may be participants and kind of answer our interviews as kind of part of this work. If you're not and you would like to be part of it, then please just reach out. On that note, if you have questions that don't get answered in the session and want to reach out, also please do. I'm always happy to answer them offline. It'll be a bit of a whistle-stop tour. We're going to cover a lot of topics, so I may have to go a bit quick through some bits, but then, of course, very happy to answer questions offline or even at the end. We've been doing it for over a decade. It is kind of 1 to 1.5 hour discussions with advisors. It's always a one-to-one discussion. It is independent and it's market representative. So I know, today we're obviously presenting, to Graviton. But I think a key point here is that this is not an influence sample. Any provider, any DFM, anyone can be part of this in terms of our client base. And so when we go and we speak to advisors, we are coming independent, right? We are asking them for their raw and unfiltered views. Sometimes we have to kind of tailor some of the answers if we're getting too much raw and unfiltered feedback. But I think it's a key point is that we are getting a lot of the time here really raw and unfiltered views from advisors on what is working and especially what is not working. Now, Q3 is the collection period. So this was 2025 Q3. So that's the context of the market. That's when we were speaking to advisors. It was 180 one-to-one discussions with advisors. Doesn't sound like a massive sample, but that's about 160 unique advice firms. And so if we just, as a thought experiment, start listing out different advice firms that we know, by the time we list the kind of 50 or 60 largest, we've covered the big ones that everyone's kind of aware of. I think in South Africa, there is a lot of, what would say, fragmentation, especially toward the longer tail or the smaller advice firms in market. But there's actually quite a lot of concentration. We'll get to that in the largest firms. So we believe in the 160 or so firms we speak to, it's a pretty good representation of the market. We also speak to about 15 DFM executives, which we think is actually more than the size of the DFM market, if we're being frank, and about 10 network executives. So we triangulate views across the market here. We also do run quarterly market share stats that will allow us to triangulate. So if advisors are saying net flow is a challenge right now, then we'll look at our market share stats and see, are we also seeing that in the data? We are. Great, so I'll jump straight in. So I think the first piece is really around what market context are we operating within, and how do we grow that value line or the revenue line, or kind of define that piece there. So I'm going to start with our market share stats. This is not from advisors, but this is rather from all of the providers that submit to us, and any given platform will say, I have this much in assets, this much in flows, etc. We combine that across all the businesses in the market, and then we report on what we're seeing. So right now, at the end of 2025, end of December, we were up to about 3.2 trillion rand of assets. This is across savings and investments, and this is across all channels. So this includes tied agents, this includes any direct business, but the vast majority of this is non-tied advisors. Right? Now, what's interesting about the assets is you can see we're 14% up per annum over the last couple of years. In the last year, actually Q4 to Q4, I believe it's about 17% up. And so I think it's interesting because most of us and most of the value chain, the revenue is tied to this number. The revenue is tied to the assets. So it's a really good time actually to be in the industry, and from this perspective, because you have to be trying really hard to grow your costs ahead of this. And what that means is for most businesses, the profitability is looking pretty good, and it's outstripping kind of cost growth. But what's interesting is when we start to look at the net flow, there's a bit of nuance around that. And so what I've got here is since the start of 2020 and down to the end of kind of 25, end of December, I have each quarter's net flow, and I've just mapped in the Q4 figures here. But firstly, what you can see is towards the end of 2022, we started to struggle on net flow. There was very little net flow in the industry, right? And Darren's mentioned, about 16,000 advisors. That's a same number that we track. 16,000 advisors in this quarter had to share 1.7 billion of net flow. It's not a lot to go around, right? 16,000 advisors had to share that. However many asset managers, platforms, and DFMs all had to share that. So the great news is it's recovered really nicely. We have reached now a new peak. We have 23 billion in the last quarter. But before we get too ahead of ourselves, it's only 17% of all asset growth. So if we're thinking about this growth that we're seeing in assets, and it looks really strong, the vast majority of that is still driven by returns. And so I guess the key point here is enjoy it while it lasts. But if the returns went down, we would be putting a spotlight on the fact that there is not a lot of net flow actually. And it's a couple percent in any given year. And so I think the key point is if you're measuring your success in assets, everyone's doing amazingly. But when we actually put a spotlight on net flow, is that it's not that easy. And it is closer to a zero-sum game. So if for every 100 million of assets you advise on, if you're even just seeing 3 million or 4 million of net inflow on the 100, you're ahead of the market. Now, interestingly though, in that kind of net flow pocket, the two consistent ones we have seen are retirement income and offshore placements. Those are the two that have been most consistent over the last 4 or so years. So yes, it's kind of tight on net flow, but there are some relatively consistent pockets and areas that we see as areas of interest. I would argue especially retirement income, because that is something that we've seen in the UK as well as a really core focus area. So to context of the size of the market, the stock and the flow, the next question is then, well, if we've got this, this few trillion of assets, and I said earlier, the earnings is predominantly based on assets, right? It's basis points, fees, whether it's advisors, DFMs, managers, platforms, then what does that value chain look like, and who's taking how much of it? And I think Darren in the introduction did talk about, well, the managers are doing this role, the platform's doing that role, and the advisors are doing this role. What I've done here is I've really just drilled into specifically the advisor and what the advisor's taking home, but I'll voice over a little bit on the rest. So what we're looking at here is a bottom-up value chain from the advisor. The platform is in here, The DFM is in here if an advisor uses a DFM, but overwhelmingly, increasingly, advisors are using DFM. So the vast majority of people we're interviewing are, and then the asset management fee as well. It is ex VAT. For the asset management fee, it's also AMCs, right? It doesn't include performance fees or anything like that. In South Africa, if we look at 2025, we're now at a point where it's a bit over 2%. So it's 211 bips is the average fee we get in our study. I do want to caveat that our study does focus more on the higher end, the leaders of the advice industry in South Africa. And so these are going to actually be a little bit lower than what the true average advisor out there is charging or kind of seeing in their books. But we're seeing a bit over 2% in fees, with the advisor taking roughly 60 bips or 28%. I'm going to come back to the red blocks in a second. In the UK, what's interesting is we now in 2025, at the end of 25, we had a value chain of 185 bips. So it's a bit cheaper than South Africa. Nothing dramatic, but it's a bit cheaper than SA. But the advisors are taking 75 bips or 41%. On a percentage basis, this is really interesting because in SA, it's just over a quarter going to the advisor. And in the UK, it's just over 40% going to the advisor. So the fees on a raw basis are higher, and as a percentage basis, significantly higher. So firstly, I mean, this just looks interesting to us, and we'll explore a little bit around it. But I guess one of the reasons why this is particularly interesting to us is we look at the value chain, and we think that the advisor has by far the strongest relationship and the most power in this value chain. And so it's strange to us that the advisors in South Africa don't seem to be really charging the fees that they're able to command in other markets, and that the rest of the chain still is, as large as it is. In the rest of the chain, I think just interesting quick points is platforms generally aren't meaningful profit centers. They're doing their best, they're reinvesting, but it's kind of hard. They don't have a lot of margin sits in there. DFMs are surprisingly actually lower margin than you may think. Asset management is still really the biggest margin that sits in the rest. Average platform fee is somewhere around the low 30s to mid 30 bips. Average DFM fee is 29 basis points in the study we've run here. Now, I think what's interesting, firstly, is that we have seen advice fees going up very, very slightly in South Africa. In the UK, it's been more significant. The advice fee has been increasing. And actually, if we go all the way back to, was it 2013 or so, the RDR in the UK and sunset clause, when the commission was switched off, even back since then, it was rising advice fees. And we therefore think that in South Africa, we're going to continue to see advice fees go up. One of the main reasons we think it's going to go up is just that your cost to serve clients is going up. So if the cost to serve clients is going up, the number of clients you can serve is coming down because of kind of regulatory burden. The only way this equation balances is if you end up charging a higher advice fee. And you may have to develop your proposition to do so, but we think that that's something that we see. The other bit that's interesting, though, is these guys here. We call them HOL, holistic advisors or holistic planners. Really, what this is this is our top tier advisors. These are advisors that have the highest average balance, the high net worth clients, all of that. And so I think what's interesting about these holistic advisors is that if we think about them as the kind of high net worth end of the advice market, in South Africa, they discount their fees. They charge less. In the UK, they charge more. They say, this is a really sophisticated professional service. This is not a commoditized risk profiling process. We're going to charge you more for it. It's 81 bips. And if you don't like that, you go elsewhere. And actually, it's interesting. Some of these holistic advisors, they'll charge you a fee up front just to have a discussion where they decide if you can or cannot even be their client. And so what's interesting here is that in South Africa, still at the moment, some advisors in the high net worth space are saying, yeah, but I'm nervous because if my client turns the fee from bips into ZAR, they're going to see that it's a lot of, it costs a lot. It's a lot in ZAR. But I think the counter argument is that everything is force multiplied by those assets. So if you make a small mistake, or if they're not in the right tax wrappers, or if anything is done wrong, the downside is also multiplied by their assets. So we don't buy this argument that the bips turned into assets is a lot in ZAR, and therefore you must discount it. But I think it is just an interesting one that speaks to confidence at the moment in the market. So I'll go quickly through this. UK is exact same structure as South Africa. It sounds the same. The fees look very similar, et cetera, et cetera. Australia does charge some flat fees, so dollars per year. So if you are looking at a market that does that, it's Australia. I think it's more just as a result of, Darren talked about with Royal Commission and the compression in number of advisors. I don't think people really seem to want to be going to those kind of dollar per year for advisors, but I can talk about that offline. Now, one thing we've noticed is higher advice fees correlate to confidence. So the advisors that are most confident are most able to charge proper fees, and the advisors least confident seem to be the ones most likely to discount or charge least. And so you may ask yourself, well, what is it that drives an advisor's confidence? And so a key part of that is knowing you're talking to clients about the things that they're interested in would drive confidence. And one of those that we're going to come to on the next couple of slides is, I can tell you what doesn't seem to drive confidence, and that is linking your value to outperforming the market. Because at best, that is true part of the time. And it's a fact that at some point, you're not going to be outperforming the market. And if you've tied your value to outperforming the market, you may feel less confident around your advice fee. So we've asked advisors on the next slide around this point, we've asked them, how do you demonstrate the value of your advice to clients? And especially if we're in a context where market gets tougher. Like right now, returns have been great. So maybe it's not right now. But if the market is tough, how do you demonstrate the value of your advice to clients? And so there's four main ones that we've seen. Firstly, discount your advice fee. Secondly, pretend you're an asset manager. Talk about the daily movements. Discuss Japanese microcaps. Join them in the weeds. The third is to act like a developer. Make your own systems. They're all fragmented. None of them integrate. But as long as it's flashy, the clients will be happy. And do it all alone. Right? So we talk about one-man band or one-woman band. But here, demonstrate to them that you are actually alone and you're doing it all by yourself. Now, if it's not clear, this is all tongue-in-cheek, but this is what we see sometimes as the wrong moves and look, I'm purposely trying to be a little bit controversial here, and you could just disregard all of it and say, well, I think I'm wrong, it's fine. But what we see here is all of these are things that sometimes advisors have done or kind of do double down on, but we think these are actually distractions or risky. So firstly, any discounting of advice fee, especially when markets are tough, right? It undermines confidence because all it's doing is kind of showing them that you're not confident and that you're now kind of trying to give them back some of the fee. We have seen examples of where this sets a precedent or it opens a can of worms. Because I know one advisor's told us, for my high net worth clients, I said, you know what, I'm going to discount by 10 bips. And then that just opened them a can of worms because they said, well, for how long have you been keeping this extra fees and the margins that you could have been giving me? And, how much more could you discount me, etc. But the most fundamental one for us is that as soon as you're discounting your advice fee or not actually charging what you should be charging, you can't invest in improving the operation. And especially if we're looking at some changes coming through, whether it's AI, whether it's regulation, whatever it is, we think that the advice firms that have margin and have the ability to invest are going to win. We think the role players and asset managers is an interesting one. Look, very few advisors at the moment in South Africa that we speak to are doing this, but I think it's an interesting one to flag is that we think that a lot of the value that advisors bring is not joining them in the weeds, but bringing them out of the weeds and back to what's the big picture. Right. Yes, the market's down 2% this week or whatever. But actually, if we take a step back and we look at the flight path or the plan or your goals, you're still on track. Other clients have seen a GFC. Other clients have seen COVID drops, but they all made it through. And I think the key bit here is kind of bringing them back. But also the other thing that we've noticed as an interesting aside point is that advisors that focus a lot on being asset managers or talking about all the detail, they talk a lot when the markets are up and they go missing when the markets are down because all of a sudden they're kind of less keen to have that conversation. And that's when clients want engagement over insurance the most. So I think it's a key point is that sometimes, and it's true for asset managers too, is that actually it's when the markets are down that people want to hear the most and they want the reassurance. The piece around portals and tools, I do not want to make it sound like there shouldn't be tech investment because we think there's a huge opportunity coming through in tech. But we do think that when it looks like it's done right, it started with a problem or a purpose in mind. It was around efficiency, consistency, or some form of quality or compliance. But we have seen this go wrong. We have seen advisors just adding systems on a regular basis. They don't integrate. And if anything, it has reduced efficiency, not increased efficiency. So I think, again, it's a key point is that tech doesn't automatically add value. It has to have a problem in mind and streamline things. And then the other bit is that this doing everything alone, we find actually clients gain confidence when someone says, you know what, this is where I focus and I have experts that do this and I have experts that do that and I leverage their services. I think an analogy here is just the fact that if you hire an architect and you're trying to build a house, you don't then expect them to go and be the bricklayer, right? So there's someone has to design this thing and someone else is going to implement and do things. So this slide was obviously a bit tongue in cheek, but if we bring it back to the data that we're receiving from advisors, the good news is this is not what most advisors are telling us their value is. When we ask advisors where they think, the real answer to this question, what they say is the plan and the process. Sticking to that, keeping them on track, a plan that stretches over periods and reaches specific goals, right? So this is a core part of the value that advisors tell us they deliver to their clients. The expertise and capability, right? We've been in the industry for a long time. We have experienced this. We have a multidisciplinary approach that could be, the product sets covered. In this case, an advisor mentioned actually the expertise of having a DFM, right? Not just two blokes in the office, which I like as a quote. Obviously, these are all quotes from advisors, just to be clear. A little bit here just around saying, well, look, I've saved you costs or tax paid. Service and responsiveness and relationship and trust. And of course, there's this key bit here around client connection. So it might be around, I'm going to sit down with you, I'm going to interact with you a lot. And there's bits just around the fact that this is personal, we're honest. When COVID hit, some of the advisors, they reached out to their clients and said, look, we don't know the answer right now, but we're monitoring it. We have a team on it and we'll keep you posted. And I think that does a lot more around building that transparency and honesty rather than kind of saying we're an asset manager or we are, one-man band and we got this all covered and we don't use anyone else. Interestingly, from our client work, we think the clients value this client connection more actually than the advisory capability, but they're very interlinked, right? Often the trust comes from the planning and process. So they're interlinked. So this is the demonstration of the value or the kind of reinforcing of what the value proposition is. And I think some of the last slide is some of the distractions that we see. But I think as we talk through this core and distraction a bit more, we look at, other than charging a proper advice fee or charging, a higher advice fee, what's another way of growing your revenue line? And the most obvious one is to grow your client count. And when we ask South African advisors, what is your source of new clients? This is what we found. We found that 5% was other, and I'm going to talk through that in a minute. There was a little bit of referrals and partnerships, so firm referrals and partnerships, but more than 3/4 of all new clients to advisors, they told us, came from referrals from the existing client base, 76%. So quickly, just on the other, there was a DFM CEO, right? Because we interview different parts of the value chain. And sometimes we ask the DFMs to comment on what are they seeing in their advisor base. And you can see this one mentions that some are using online models, right? Instagram, TikTok, radio, podcast, but it's 5%, right? So it's interesting. It's 5%. The one that I think is really interesting here is this more than 3/4 of all referrals that are coming from the existing base. And this quote here from a DFM CEO saying it's accidental. This 76% is accidental. And that's great because it means you've done such a good job with your client base that they referring friends, family, whoever, they're referring those guys to you. And so I think that's great. But the point here is really interesting, which is what if they actually optimize their referral strategy? And you may have to bring on another advisor. You may have to develop efficiencies to deal with more clients. But I guess the challenge to those on the call, right, is to say, is this true for you? I.e. that are you in line with these rest of the advisors we interviewed, which is most of your growth is coming from referrals? And if that's true, do you think you've optimized that referral model? And I think what's interesting, so if you're within a broader kind of family or group, and let's say in this case, the Graviton link, is I think there's a lot of sharing of notes and best practice, and that could be done around this, right? Because most advisors we talk to are by themselves, one person, and they're trying to figure this all out, right? And so it's not that easy. But I do think what's interesting when you're part of a kind of broader kind of, let's say, family here in this case, is some of you will have figured out things that others haven't. And I think the sharing of notes and optimization of referral model is interesting. And I'll come back to it, but I think what's interesting when we talk about core and distraction is some advisors come to us as small advice firms and they say, I'm going to go out and I'm going to buy other small advice firms. And we look and go, oh, that could go wrong in a lot of ways. Firstly, generally a one-person advice firm has a very entrepreneurial, smart, driven person, but with a lot of quirks. And even if your firm looks the same as that firm over there, chances are you don't agree on all the things you think you agree on. And so when we see smaller advice firms trying to buy smaller advice firms or partner, it goes wrong more often than it goes right. And there's always a lot more to figure out, and it's always messier. But it's interesting to us because we're hearing about this inorganic growth strategy and buying up another advice firm. But we're then asking, well, have you even optimized the kind of organic-ish, growth in referrals? And most of the time, the answer is no. So you've got this low-hanging fruit, but we're not yet seeing that optimization. And the other bits just worth mentioning, just while we're on the client discussion, I guess the other bits we think are important is where relevant, advising the broader family becomes quite important, especially around how you retain assets if there's any transfer. Key point here is that the advisors that really excite us are when we ask them, how many clients do you have? And they say, it's less about how many clients I have. It's more that we deal with 90 families or something like that, because that means they're starting to think more holistically about that family. Now, obviously, it depends on your client base. If your clients are 30 years old, you're not going to be bringing their children in. Customer segmentation is important. And then tech is important in terms of really understanding your client base, segmenting them, and thinking about how you can implement some of these strategies, right? Like CRM as a clear one. But so I think this is just an interesting one here around what's core and what's a distraction. I would say what's core is getting referrals and growing your advisor base on an optimized way. What's a distraction, potentially, is acquisitions if you're not a large scale firm. Obviously, if you're a firm 20, 30, 40, 50 advisors, there's a lot of opportunity right now to go and find advisors that want to join, and we'll touch on that on the next slides. But if you're a one-person business, going up and buying other firms we think is more of a distraction than the main thing. So then if we talk about headwinds and driving efficiencies. So I guess headwinds, what are the pressures that reduce our efficiency? And then how do we then drive efficiency in that context? So how do we not see those costs go up? So we start with this question where we ask advisors, what keeps you up at night? What are you worried about? It changes every year, more or less. There's some things dial up, some things dial down. A couple of years ago was load shedding. I hope we don't see that one back on there anytime soon. But at the moment, the biggest one is regulation. And the size of the word is the number of citations. So in other words, most advisors we spoke to, they were more likely to say regulation than anything else. And so I think that's an interesting point. We'll come back to that. But I'm just going to give some quick quotes on what we see. Market returns. Advisors are worried that they're going to let their clients down sometimes on returns. Now, obviously, right now, performance has been good. So this is maybe not at the forefront, but this is something that is mentioned. And I know I mentioned earlier a bit about role playing as an asset manager, but you can't disconnect the fact that the returns are core in meeting the goals that the clients have, right? So this is always going to be implicit there. Global politics, right? So I guess you could look at this a couple different ways. Normally, it's South African politics in the past has always been the problem, right? We're worried about corruption. We're worried about local instability, blah, blah, blah. And they were less worried about the rest of the world. Right now, I guess we're much more worried about what's going on in American politics than South African politics. So maybe that's a positive for South Africa, and maybe it's a negative for the rest of the world. But this is something that we find advisors are currently quite concerned about. Unpredictable politicians. We're not going to name names, but that is something that pops up. But this regulation one is a really core one, right? Compliance is becoming onerous. I worry advisors will exit the market. We're going to come back to that and see, is there evidence that advisors do exit the market? But I think this regulation is a key one. Just as I liked this other quote I'm going to pop up. Not all advisors are worried, right? Some of them are saying business is good. We had this advisor here who said, the only thing that's keeping me up at night is if the Springboks lose test matches. For context, this was right after that Ellis Park game where we lost to Australia, and I was unfortunately there in person. So hopefully now this advisor is less worried about that. But I think the key point here is not all advisors are doom and gloom, but the big concern really here is around regulation. And I think the interesting point around regulatory burden is that it increases costs. It's either just an explicit cost addition, or it's also just time. Because if you're spending more time on compliance, you've got less time to see clients, which means your client count comes down, and therefore, you've got impacts there in terms of the number of clients you can have and the revenue you can generate. And so what's interesting here is when we interview advisors is that there's more and more every year that say they're interested in joining a larger firm or selling their book. And in the UK, this number's up to 19%, and it grew very quickly when consumer duty, which is a regulation that we saw in the UK, when that came through, this went from 9 to 19. And you can see in South Africa, this number is rapidly going up as well. So more and more advisors look at this and say, regulation, obviously, compliance is important. The quality of advice is important. Doing right by your clients is important. But advisors are saying, this is not the main thing for me. I want to be compliant in this, but I want to sit in front of a client. I want to reassure them, work on their plan, understand their needs. And this is the main thing for me. This is where I deliver value. And sitting there and doing admin is a distraction for me as an advisor. And so when we see advisors saying, I want to be in a larger firm, what's interesting is the top rated driver is culture. They say, when I choose a firm, I'm going to choose based on culture. Now, I have no idea how to define this, but I think most people have a gut feel for if the firm they're in is a good culture or a bad culture. I do have to flag at the moment, we're a little bit nervous in South Africa. We can see what happened in Australia, what happened in the UK is when people started joining larger firms, we started to see some really dodgy stuff happening. Now, it goes without saying that we would not count Graviton in there, but I'm not going to name the names that we would count in there. But we're starting to see what we saw in the UK, which is high multiple, aggressive switching, expensive solutions, ripping off clients. And I'm hoping that we don't see that continue or that we see that reduce, because we saw it in Australia. Darren mentioned Royal Commission. It blew up that whole landscape. We're now seeing it in the UK. There's fines going out to the big firms, but we're hoping in South Africa that advisors keep thinking about culture and that networks keep thinking about culture, and that we don't see this kind of concerning, expensive, rapid switching kind of behavior that we've seen in these other markets. So what happened in the UK as a result of this regulation that came through? Firstly, if you remember that what keeps you up at night chart that I just showed you with the words, in the UK, I just showed you this quickly as a chart, right? Because we could show it a few different ways. What we found was regulation and budget or government intervention, which is kind of falls under the same category, but it's multi-choice, so it adds up to over 100%. This is the biggest issue. And the smaller the advice firm was, the more likely they were to be concerned with these bits. And what we found was advisors told us in the UK, they said, as a result of consumer duty, I'm going to have 8 hours of additional work per client per year. We think it's maybe not quite that high, but it's something high, right? It's an increased amount of work. And so we found is 34% of advisors told us, I've had to reduce client count. 27% say, I'm going to have to further reduce client count. So number of clients being served goes down. Advisors increasingly looking to join a larger firm. And again, this culture piece comes through. They say, I want to sell to someone that looks just like me. But in reality, the smaller firms that look like each other often have the same issues. So what we found is advisors are grouping up in the UK into larger firms where they're saying, I'm not going to spend as much time. I'm not going to have to deal with this compliance burden. Instead, that's going to be covered by the firm. And I've got a little bit of support. I can help. Succession plan is also a big part of this as well. And instead, I'm going to focus in on the giving of advice and what I think is cool. And so I guess it's the first bit, right? So if I dump back to, okay, what's a distraction and what is cool? On this theme, we would say, unfortunately, compliance burden and regulation, we would say for most advisors, is a distraction, though of course you want to give us good advice and the quality of advice is important, but advisors saying what's core for me is sitting in front of my clients and giving advice. And so this is kind of what we've seen there. The next is around centralized investment propositions. So DFM usage in South Africa and the UK. In our interviews, we're now at a point you can see each year, the interviews that we complete, 72% of the IFAs we spoke to said that they use a third-party DFM, right? And so I think all of you on the will be familiar with the term, but in this case, we would count Graviton as a DFM, but Morningstars and PMXs and those businesses, right? So over 70% of advisors we speak to. That said, remember I mentioned up front, we talk to the kind of leading firms in market, and across the whole industry, we think it's closer to 40 to 45% of advisors that use DFMs, and that's mostly because not all of the DFMs have gone and spoken to the really small advice firms, right? There's been a kind of preference to speak to the highest ones. And what is interesting is that we found that the importance of the relationship, this is from IFAs in our sample, it comes back as 9.2 out of 10 for my DFM, 8.5 out of 10 for my platform, but the asset manager importance is not as high, saying not as much of a partner, but increasingly the DFM's my partner. In the UK, we see firstly, the centralized investment proposition is an important piece, right? It's a distraction would be to not have a centralized investment proposition and to try and kind of figure it out on the go. And so what we see now is 93% of all IFAs, we've stopped asking it actually in the UK because it's kind of become obvious now. 93% of all advisors we speak to say, yes, I have a centralized investment proposition. And it doesn't have to be a DFM. It could just mean I've figured out like the house view. We've got 5 customer segments, and for segment 1, 2, 3, 4, 5, here's the answer, right? But at least that means that you only have to figure out when you speak to a client which of the 5 they're in. You don't have to figure out how to build a solution for that, right? And mostly though, that is a DFM, or what we call in the UK MPS, which is it's similar. It's kind of a more tech-led, streamlined, light touch, less partner version of DFM, right? But it's very much the same thing in the South African context. And so you can see very similar kind of trend here, which is kind of increasingly working with DFMs. Now, I'm going to come to something a little bit around core and distraction later, and kind of touch on that again. But as soon as we start talking DFMs, we start talking, some advice with Cat 2s and all that, we also get into the fees and where the fees are generated. And I think there's this interesting question here then around the fee models and the partnerships that we see between advisors and their DFMs. And I'll touch on that just again. Then finally, if you recall, I mentioned technology was a potential distraction in some ways, but a potential driver of efficiency in others. And I think there the nuance is really around how it's implemented and what the problem is that we're trying to solve. So what I've got here is what advisors in South Africa are telling us their usage of AI is. And this was from last year. The year prior, advisors didn't really have usage. They just had theoretical outlook. But now we've got enough advisors using it to tell us what they see. So we've asked, how are you currently using it? And how do you think it may be used in future? And again, I'm not an AI expert. This is just me presenting back to you what you and other advisors like you have told us, right? And so at the moment, what we're finding is the biggest chunk is what we've called client engagement and communications. Email wording and polish, monthly wrap, note-taking, transcription. I think interesting point just on the transcription side is that Darren did mention the average age of advisors at the very start, and it's not overly young, but we find advisors are adopting AI faster than anyone else that we deal with, right? So it is an interesting one where I think advisors are at the forefront of integrating AI into how they think about their business. Not all, but a lot, right? So most advisors that we interview now join with a Fireflies or something as part of the discussion. So I think it's quite an interesting one there. But at the moment, it's predominantly client engagement communication, but it's also research and analysis. So if I'm being asked a question on something quite technical, but also if I need to research different products, or if I've been sent this big document or thought leadership document that's 20 pages and I'm trying to figure out what actually matters, then I may put that through. Or if you've got a colleague that sends you particularly long emails and you're just trying to figure out what you have to deal with in the email, it might sometimes go in there as well. But what's interesting is where we start to look at where do advisors think this might change? And what we're seeing is the potential uplift advisors are seeing is really around efficiency in operations and compliance, which, part of that. So basically, how do I identify repetitive tasks, whether, whatever it is around compliance documents, onboarding, menial tasks? There's a little bit around, can it help in the advice process, right, for client reviews or something there? But I also like this, it's only 3 up to 9%, but some other people are starting to think about, what about business advice and challenging me as an advisor? Because you could just say, this is the way I run my business and give me some challenge, because I think this is most relevant, I would say, for one-man bands or one-woman bands, smaller businesses, as I mentioned earlier, that can't really leverage other people. I would think that obviously all of yourselves on the call, this strategic ideas, the opportunity analysis, I would start by just chatting amongst yourselves, right? I think there's probably a lot more you can get there. But I think especially for one-person businesses where they don't have peers that they can talk to, this is going to be quite an impactful one. It's kind of challenge my thinking, come up with ideas that I can. But I really think this efficiency in operations compliance is a key one. And so I think most advisors at the moment, we can see it as an opportunity in future. It's not quite there yet in terms of how it's being implemented. So I'm going to pull this together in different ways and then kind of talk through again and pull it finally into a wrap up that's going to talk about what we see as revenue growth opportunities, cost reduction or efficiency drivers. And then I'm also going to add on a little bit of what we see as a longer term view. But first, what I've pulled in here is partner perspectives. And so what I've got as partner perspectives is, if you recall very early on, we interview financial advisors, but we also talk to the rest of the value chain. We speak to discretionary fund managers, executives there, and we speak to platforms, we speak to all parts of the chain, and we speak to sometimes executives at networks. And some of these businesses will see a lot of advisors. And so we thought it'd be interesting to ask them, what do they think about advice models? What do they think advisors are, doing really well? Where do they think advisors could focus a little bit more? So the first one, which advisors have told us is the primary partner to their business, if you recall earlier, was a 9.2 out of 10 importance as a partner. We've asked the DFMs, where do you think advisors spend too much time and too little time at their too much effort or not enough effort? Now, just to avoid any awkward discussions or put anyone on the spot, these quotes exclude Graviton. So this will be other DFMs out there in the market, but this is general commentary around what we have seen DFMs say. So I mentioned earlier, we're erring on the side of controversy, right? Hopefully it's more thought-provoking. I didn't want to come out here and just give you a bunch of vanilla things that just, it's what you've heard. So this is what DFMs, other than Graviton, have observed about the advisors in the market, and they're saying too much effort, not enough effort. And so I think some advisors think they can't charge fees unless they get involved and change a portfolio. And what's interesting, by the way, as we're going to get to the slide, is that this NMG Consulting's view, the slides prior to this, we have reached certain conclusions. And then what I'm putting up here is the conclusions that DFMs have reached. And I think you're going to notice that it's more similar than different, right? And I quite like this quote here. It is provocative, which is where DFM says, an advisor is on the road to extinction if they believe fund picking is what justifies their advice fee. Now, there's a little bit of a bias here because obviously a DFM would like to be doing that process. So there's a bit of a bias. But I also want to flag, this doesn't mean they're saying you can't do it. It's more so that if you think that's your advice fee, if you think your advice fee is to pick that fund, and I agree with that, because if we ask the clients, they tell us the value we're getting from the advisor is the reassurance, the connection, the spending time with us, the understanding my needs, the building the plan. And so I agree. I think that, especially, we talked about robo previously, but now we've got robo and AI. If you, as an advisor, if your entire job is to just risk profile someone and then choose a bunch of funds for them, that does seem hard to justify increasingly or defend the fee. As part of that, we talk about short-term movements, maybe too much effort talking about short-term results and watching the markets. As this inorganic growth versus growth and referrals, I thought was interesting because, again, that's reinforcing what we've seen in our conclusions that we've formed in speaking to advisors. And so here, I think this comment, it's hard for small firms to make acquisitions, right? You're not M&A experts. How do you find them, negotiate it, and how do you onboard a client base that has a different value proposition? And so, again, I think smaller firms, it's really tough. But at the same time, is we do find that if an advisor runs, there's nothing wrong with saying, I'm going to run this like a lifestyle business. I'm very happy with my client base. I don't need to grow a number of clients I'm dealing with. It's fine. And do what you want at the end of the day. It's your client base, obviously. But I think this interesting comment is that it's sometimes harder to grow or bring in advisors if you don't have this growth story, right? So how do you bring in a succession plan if you're saying this business is done, right? I'm kind of happy with where it's at. I'm not kind of trying to improve or grow what we're doing. So I think it's a bit more exciting sometimes for people to join a business that's saying, look, we're looking to grow, as not doing enough in engaging existing clients for more share of wallet or referrals. And I think that's interesting. Regulation. Advisors aren't taking succession regulation seriously enough. I challenge this because I think what we've seen on the previous slides is that advisors are very much aware of the threat of regulation. I think the challenge is most advisors we speak to are saying, it's not even clear where I'm going to have to start. Right? But again, this one's more so for advisors that are still operating in a one-person band situation. If they're in a larger firm, this is much less of a concern. And then finally, this scalability and tech. I really like this quote because this is very much what I've experienced in speaking to advisors, is that we would like to think that there's this perfect middle ground where tech is in there and tech is integrated and tech is streamlining things. And it's linking various systems together. It's enabling advisors and it's making the whole thing more efficient as an operation. But what we find is more advisors seem to be on either end of the spectrum, where we find either there's very little technology in the practice or there's new systems every week and it doesn't integrate. And so, for example, we think, and based on the UK trends, we think that there's going to be this really good development when platforms like, let's say, Glacier or your Allegre's, when investment platforms just integrate with your back office systems. As that is built, so your elite wealth, what plugs into your platform, that's going to be great. And so integration is critical. But the problem we see here is that as more systems pop up, and if you're building little modules here and there, if they're not built with integration in mind, we're only going backwards. We're getting further away from integration. So I think that's the key bit is how do we get it efficient and integrated? Again, I guess the advantage you've got being a kind of broad family is that you can bounce ideas off of each other, understand best practice, and kind of see how this is done. I feel for the advisors who are one-person businesses in thinking about how to implement tech, right? So on a more positive note, we asked the DFMs, what differentiates the most successful advisors that you've seen? The top answer is the ones that really focus on the relationships and the giving advice. And I think this is key bit here is touch points and how you turn up. And that's the unique bit, right? You could be in the exact same solutions as another advisor, but I promise you, the client that walks into your practice or walks into the neighbor, even if you're in the exact same solutions, does not think you're the exact same business. If you are really focusing on how you deliver the advice proposition, what those kind of touch points look like, and how you engage with them. Dealing with families over multiple decades and through crisis, building a value proposition on advice, right? And I think this is an interesting challenge. It's often those who are light on their advice proposition who focus efforts and conversation on fund picking. I think it's a fair challenge. By the way, we see less and less of this in South Africa. Some markets are still like this, right? I would say continental Europe is still a fund picking market and is behind South Africa. Broadly, right? Market by market, it varies. In the UK, they've moved further away from fund picking. So I'm talking, continental Europe. Partnerships is a key one. We talked about that earlier. Building efficiencies. And sometimes the challenge is getting out of the day-to-day grind. What's the cliche term that we talk about, which is working on the business, not in the business, or something like that. So I think this is this point here, which is when you get a chance to take a step back and think about how could this be improved? Because when you're just in the day-to-day, you're more likely to be repeating the existing process. Clear on what the client value prop is and how do you tailor that for different customers. And there's this bonus quote that I struggled to categorize, but I quite liked it as an idea, which is where there's one or more individual with an inherent drive to build something, driving, innovating, finding ways of getting new clients, right? A kind of growth mindset, get better mindset. So I think this is quite interesting just from their perspective of saying these are the businesses that seem to grow well. Is it's not necessarily that they have this special client base or this special skill set or anything, but they just seem very keen to drive it, to build something tangible. And so if I pull it all together, this was just a kind of getting the partners' views for a sec. This is now back to our observations as NMG Consulting. Our takeaway or our challenge in some areas would be figure out what is core and what's a distraction. What is core? It might be in terms of what really delivers value. It might be in terms of what the clients perceive as delivering value. And maybe in some cases, those should overlap a lot of the time. And so part of that is how do you grow the revenue line? We think one of them is charge properly and in the right places. And on this, I said I'd come back to it. We have seen some advice firms grow. They get some power. They get a couple billion of assets. They partner with a DFM and then they'll say, I want 10 or 15 bips as part of the Cat 2 and fine. But I think what's interesting is as we see regulatory scrutiny come in, we'd look at it and say, if I were the advisor, I would have instead put pressure on the DFM fee if you want, negotiate the fee down, but increase your advice fee. It's going to get a lot easier to defend a 10 bip higher advice fee, 75, 80 bits, whatever, than it is to defend that you're also a DFM that you're. But let's park that one because some certain scale advice firms, ones with 10, 15 plus people will have their own category. I'm going to challenge instead by saying there was a platform, I'm not going to name names. I don't know if they're still doing this, but a platform came and said, we'll give you fees through dividends if you use our platform. And we look at that and say, that is a distraction. That is not core. Instead, you should be looking at use your scale to drive the platform pricing down, which is what's happening naturally, and charge a proper advice fee, right? It's the distraction is to look at it elsewhere in the value chain. We think the core is to charge properly for your time. Take the lowest hanging fruit, which is referrals, before you chase messy acquisitions. And actually improving the number of clients you can service through efficiencies does increase your revenue line. But obviously this now links to our other point, which is efficiency. So how do you manage efficiency and costs? fundamentally reduce the time, effort, and cost you spend on compliance. Now, obviously, you want to be compliant, but this is more so the more you're spending time with your client, the better. The more time you're spending on the computer and filling out forms and doing compliance, the less you're delivering